kind of came about this is I was reading a book from the great Charlie Munger, and he just put it simply that risk is just one simple thing, and that is your investment going to zero, right? And that is actually what it is. It's just that you make an investment into a bad company or a bad asset, and your investment goes to zero. Or you buy an investment at a certain value, and due to many reasons, a big portion of that value gets lost, and the stock just trades perpetually at a much lower value than where you bought it at, into perpetuity or into forever, basically. The way that happens is you buy a business that is priced for perfection in terms of its growth and its position in the market, and it gets disrupted, or it has a financial position or a balance sheet that is not very healthy. Something's wrong with the actual structure of the business model, and they don't generate as much cash anymore. Or management is not up to scratch, and management has just driven the business into the ground, right? That is your risk. So yes, it might not go to zero, but can lose a large portion of its true value. So risk is tied to the fundamental underlying business or investment that you make. That is the risk of that, just losing your money. If you invest $10,000 in a business, in the market, you invest in a business and the business just goes to zero or loses a large portion of its value for a long period of time. That's the risk. It's not the volatility of the price action. The stock price is going to be volatile, and in fact the volatility gives you the opportunity